So thank you very much for the time, Pushkar. I don't need to introduce Pushkar to anybody over here, I'm sure, because you're like the most prolific writer and the authoritative voice on D2C these days. So anyways, the event which we did with Pushkar and me, we did a couple of webinars and a couple of events. We have been addressing a lot of questions and queries, and then we got like more and more questions, a lot of deep dives. So we thought, why not just cut the entire process around going to Zoom and logging into Zoom and doing an event. Rather, we just anyways everything is happening on LinkedIn, so let's do a LinkedIn live. So that is why we are here today. So how we are structuring this is basically to initiate conversation, and while we wait for people, hey Saurabh, happy new year. So while we wait for people, we will do some discussions. I have some questions for Pushkar. I get the first choice, the first right of asking questions, and after that you can probably put it up on the chat over here, and I can ask you questions to Saurabh, sorry, Pushkar as well, and Pushkar can respond, reply. And guys, really some grilling questions, okay? So that we will make Pushkar sweat in winters, right? So so welcome Pushkar, welcome on board. So I'm closely following the series, great insights. Thanks, Amir. So Pushkar, my first question, man. I know your 2021 did very well. So how about 2021 for D2C business in India? Your insights, man. That's what we're all looking for. The entire year probably summarized in 2 minutes, maybe.
Yeah, so I think 2021 was quite an eventful year for D2C businesses in India. We saw the rise of aggregators or roll-ups, companies who acquire profitable D2C businesses for a value and then try to grow them. So five, six such companies came up in India to have become really big. Mensa brand and Global Bees. They have raised so much capital at such a high valuation that now they are unicorns. And what we saw in 2021 was a massive evolution in market because till 2020, if you are a D2C founder and you wanted to raise capital or you wanted to grow your business, the only option was going to a venture capitalist. You could go to a VC and then try to raise capital. But now there's another alternative where people are willing to buy your business, at least a majority stake, and then help you grow the business. You also have some equity left with the business. So it's a very welcome trend. Dulos, are you still there? I can't hear you, Dulos. Can you refresh? I'm saying something, but I don't think I can hear you. Okay, so I think Dulos is facing some problem in his mic. So there's one thing I just want to talk about what happened in 2021 and how market is evolving. When we saw these six, seven aggregators who just came up in India and they were trying to acquire brands, there was a mad scramble to acquire good assets. So valuation went for a toss. People were just willing to pay whatever, like if there was a good brand, a good asset, people were willing to pay 10x, 12x, 15x of EBITDA. We also saw some deals where buyers really wanted to acquire a brand and then said, hey, we don't mind paying 20x or 15x of EBITDA. But that's changing now. So we were part of a couple of deals where founder had a really good asset and they could have a bidding war between two, three buyers and extract a great value out of it. I think that time is gone because now all buyers, be it Global Bees, Mensa, Upscaleo, 10 Club, all of them have acquired at least two or three good assets. So now they are not so desperate to acquire the best assets. They already have something on their hands. They are planning to grow the revenue. So that is something how I see going forward in 2022. The valuations will come down. We are seeing, and we're already seeing that. So Duluz, can you hear us? But we can't hear you. Yeah, this LinkedIn Live is not a great idea.
Hello.
Hello, Duluz.
Yeah, Pushkar, can you hear me?
I can hear you. Maybe we can just do it without the video. Maybe it's slightly
Uh,
better.
I don't know. It's just working fine now. Your video off?
Yeah, yeah, I switched off my video because I just couldn't hear you. And this LinkedIn Live is not working well. People can hear us, but I don't, I think maybe there's a lag. So we can just
All
talk
right.
without our
Yeah, yeah.
videos.
Yeah, I figured out the problem. My pods got shifted to the mobile. So I'm really sorry about that. Extremely sorry. Sorry, Pushkar, I lost what you're talking the in the end. Could you probably repeat it? Or can you tell me what you're discussing?
So we were just talking about, so I think Dolores, someone just messaged, maybe we can shift to another platform, if that is
Oh,
fine.
that's too late, actually. Considering that you'll have to prove something and then they migrate it. I guess let's just try it out. Anyways, we're gonna
Right,
repeat it.
right.
We can try it again,
Just
right?
let's try this out. So what I was saying was what we have seen is that market has matured, the D2C aggregator market in India. Now we are seeing valuations which are more consistent on a deal to deal basis. What I mean was earlier we saw there was a good asset. Buyers were
Mm-hmm.
going as high as 12x, 13x of EBITDA to acquire that asset
Okay.
because there was a bidding war. Now every buyer has a range. So say if someone says my range is 6x to 8x, they are not venturing outside that range, even if the asset is great, even if it's an amazing brand. So because for all the buyers, the deal flow has also improved. Now more and more founders know about aggregators, roll-ups. They realize they can sell their brand. People were quite skeptical until last year because this was a new thing. So the early movers
Mm-hmm.
got a big advantage. They sold their brand at a really good price. But those who
Mm-hmm.
waited and who thought maybe it's a good time just to wait and watch and see how the market evolves, now they will
Mm-hmm.
struggle to get a good price.
Mm-hmm.
They won't struggle to get a good price, they will struggle to get an outlandish price. No one will buy their asset at 12x, 14x of EBITDA, but they'll still get a great price
That's
if they're
disappointing,
interested in
actually.
selling.
Yeah? I
Not
mean, you're saying
exactly,
the golden days are
because
over?
no, no, I won't say that. But like any market, any new industry, there's
Mm-hmm.
always a mad rush at the start. Because at
Okay.
that time, there was also a risk as a
Mm-hmm.
buyer, as a seller, say if you're selling your brand to a D2C buyer, you didn't know what to expect.
Mm-hmm.
Now, at least
Okay.
they have acquired quite a few brands. We are getting a lot of feedback from buyers, like how the integration
Mm-hmm.
is going, how long does it
Okay.
take to carry out the due diligence. So there's more clarity. So I think the
Right.
risk has also diminished, and so has the price come down.
Interesting, actually. Um, so, in the videos which we were doing earlier, right? We had a lot of questions popping up, right? Some of the questions were around factors like due diligence and founder experience and integration issues and whatnot. It sort of derails the deals. Any insights from 2021 which you can share on the most common problems you faced where the deal didn't go through? If you were to prioritize it, like number one issue, number two issue, number three issue, probably just briefly touch base onto it.
Okay, so I think it's still very early to get seller feedback, like how well the integration is going, because
Mm-hmm.
most of the deals happened, most of the LOIs were signed in April, May, and June, and
Mm-hmm.
it takes at least 3 months to complete the diligence. So they are
Mm-hmm.
still early days, but what we have seen is the diligence takes much longer than what you expect. And there's a lot of documentation to do. They ask for so much data. There's always a rush towards the end to close the deal. So I'll give you an example. We were doing a deal and we signed the for a home and kitchen brand. We signed the LOI in September, 1st September, and there was a 90-day exclusivity. So it was valid till September, October, November, 30th November. The idea was to close the deal by 30th November, finish the diligence, and close the deal. But the data request took so much time. The auditors were also not sure what kind of diligence to do. There were 20 legal points after that, and once the diligence is done, once you get an offer, a formal offer again, there's also a lot of formalities to do. So the deal got finished last yesterday, 25th. So there was almost a 2 month delay. So that's what we are saying. Like as a founder, if you think like, all right, you'll be able to complete a deal in 3 months and get the money, it's slightly
Mm-hmm.
difficult, at least because the lawyers and the auditors, the kind of data requests they will have, the kind of questions they want to know. For example, you would have to get 20 NOCs, you'll have to do several insurance. Like usually, small founders, they don't have all this data ready. So
Mm-hmm.
it's a nightmare getting everything sorted. And
All right.
sometimes founders just can't focus on business. So one case we realized that the founder was just not able to sell because he was busy with the due diligence the entire day. So it's slightly challenging for solo founders, especially those who don't have a good CA.
All right. Yeah, you've been emphasizing this point again and again, right? I think it's not just about the due diligence bit, also on the negotiation as well. Having a good CA really helps, isn't it? Having everything in place. It's also what when things are more ordered and organized, you can command better pricing as well, right? Is that still the case? As you said earlier, that the market is maturing, right? The exorbitant pricing or the really golden period is over, and now it is maturing into an actual pricing model, right? So, is it still the case that this adds value, that kind of negotiation which you said earlier, right? Wherein the founder gets only probably sell only 51% stake to the aggregator, and later on, a phased manner, they hand over the company to the aggregator, and thereby getting more money out of it, based on growth. So is it still the case? I mean, or anything else changed from the negotiation bit or the pricing structure bit or something like that?
No, I think that's still the case, especially if you're a slightly bigger seller. So if
Mm-hmm.
you're doing maybe 1.5 crores every month, there's
Mm-hmm.
still strong interest because there are not many sellers like that. At least who
Mm-hmm.
sell online. There'll be thousands of offline such sellers, but no one's buying
Mm-hmm.
offline brands. People want to buy online brands.
Okay.
So there's
Okay.
still a lot of scope on the negotiation bit, but
Mm-hmm.
more than just extracting a higher multiple, I think what most founders should look at while they're negotiating is the right structure.
Mm-hmm.
So nowadays, buyers have also realized that, all right, some founders want 100% exit on day zero, which is
Okay.
also fine. While there are some buyers who will say, like there are some founders who want to be part of the journey, who want to grow
Mm-hmm.
the brand with with the buyer. So they are
Mm-hmm.
thinking of buyer more like a VC. That all right, buyer is
Okay.
investing in us, even though they
Mm-hmm.
own 51%, we can grow the
Mm-hmm.
brand with them, and we can have our stake for a longer time. So
Right.
buyers are also signing different structures where
Mm-hmm.
sellers they are also considering giving seller equity in the parent company eventually.
Mm-hmm.
Like after 4 or 5 years, some of the seller equities gets converted into the equity of the parent company. That's also
Okay.
structure some buyers are exploring. So now I
Okay.
think the scene has moved more from a plain Jane, plain vanilla EBITDA multiple, more towards structuring. What do you
Mm-hmm.
want? What does the seller want? And how can we have a win-win deal for both parties? That's what we are
Yeah,
seeing.
nice, actually, isn't it? Which is quite nice, that's interesting actually. That gives more space for negotiation and more room for negotiation, right? A related question from Himang over here is that can an Amazon seller sell, their business, given that they sell commodities kind of stuff with no uniqueness, doing 15 lakh kind of monthly sales with healthy EBITDA, or how does the dynamics work here? I mean, Himang, we have addressed this query again and again in our videos, but then of course, I assume you haven't seen that. So Pushkar, you want to quickly address this?
Yes, so I think as long as you have a brand, if you're not selling something generic, you can sell your business. So it can be a commodity. Say, for example, a cloth could be a commodity, or a treadmill could be a commodity, even like a plate. But the idea is that you own the brand. You're not selling someone else's brand. So what you might be doing is, say, if you're importing a brand from US or Italy and selling them online in India, that might not work because in that case, buyer won't get anything. Like buyer is just getting some cash flow. They don't know how long will that last.
Sorry. Okay. I had mirror in between. I was typing and I didn't want to disturb the flow. Right. That is that, Himang. I hope we have addressed your query. Um, you know, so Yeah, there's another question from Vinod here. Hey, Vinod, you're not, probably next time we will try a different platform. I hope it's working well right now. It was my mistake. How would decision making takes place in case of a buyer wants to join Journey? Is it purely share or equity holding? Again, something which we have addressed, I guess, Pushkar, right? But maybe you're getting a pro at it. Quickly briefing and to the point, maybe answer it.
So there are two broad structures. In case, say you are a seller and you own the brand in your personal capacity, you sell the brand, you get the money. The buyer just gets the brand. You are selling the brand under a company, LLP, doesn't matter. You get to keep the company. But what we have seen is in 90% cases, the company or the LLP owns the brand, not the seller in his or her individual capacity. So in that case, you have to sell the equity shares of the company. The idea is eventually the buyer will acquire the company.
Awesome. So we have another query again. Virupaksha Prabhu has something for us over here. So I just realized we can display these queries on the screen. So it's like pretty awesome, actually, that Visa.
Yeah, yeah. I-
In suggestions for startups who does not have much capital or sales and branding, how to reach out to target customers with minimal sales and advertisement costs. Virupaksha, this is something a query of more for a growth practitioner, or a marketeer pricer per se.
Duros,
Is
you
it
can
maybe?
give your view. Like you are a
Um,
growth hacker.
it's just very subjective, right? Also depending upon what kind of audience, what kind of product, what kind of platforms, right? So I guess that needs a lot of deep diving into it. But good products get a lot of traction per se. I mean, there are some hacks. This that term growth hack was primarily designed to figure out how exactly address this problem. With minimal sales and advertising cost. With minimum advertising cost, how can you get the customers on board? And grow your brand. So that's growth hacking, right? So ideally, not that everyone is a growth hacker these days. Yeah, but I guess that's a question which needs more subjective stuff. What I can do is, if you can ping me on PM, I can probably try to help you out. Not saying I'm the right person, but yeah, whatever I know, I can guide you to someone, direct you to someone, right, relevant for that. I hope that helps actually, right? So now, quickly, I don't know whether you addressed it because I dropped out of the call in between, right? So the valuation multiples, you said it is maturing, right? So what is the numbers now? What do you think 2022, the numbers in 2022 would be like? How much times of EBITDA, how much time? And Pushkar, you might want to explain a little bit more about the TTM, ARR thingy, and EBITDA, on a layman language for a couple of us over here. In spite of me hearing it multiple times aside, multiple times, I'm still confused between TTM, ARR, EBITDA, and all. So maybe, yeah, you might want to explain that a bit more. Spend some time.
So I'll start from the very start. Aggregators want to buy profitable brands. Now, EBITDA doesn't mean anything because what we have seen in a couple of deals that the founder says their EBITDA is 20% or 15%. And when they start really doing the diligence, it turns out the EBITDA is only 5%. So that usually at that level, the deal doesn't happen because there's not enough margin in the brand. In some cases, when if the aggregator sees they can really grow the brand easily. So it depends on case to case. But rule number one is they want to acquire profitable brands, brands that are making real money. Like if you're burning capital, you might not know it. Like no one is going to buy you. At least it's unlikely that someone will buy you. Now, if we talk about EBITDA multiple, now there was of course a range last year also when they started acquiring brands. The range varied between 6x to 10x, depending upon the sector, the size of the business, how rapidly it has grown, what is the EBITDA multiple, what is the EBITDA percentage. But what we saw last time was, at least during last year, the deals we did, that brands were willing to pay a premium because everyone was new, they were sitting on a lot of capital. So sometimes they are fine going 15x, 12x of EBITDA multiple if they really like a brand. What we are seeing right now is more consistency. If any founders range is 6x to say 8x, now they'll do their 90% acquisitions in that range. So it doesn't matter what brand you own, what is your EBITDA percentage, you will get something broadly in that range. There is no way you can, there is not enough wiggle room to get a 12x multiple now. Unless you're an amazing brand with amazing reviews, you have been growing really rapidly. So I'm talking about like an average brand, not an exceptional brand. So that is one thing we have seen about the EBITDA multiple. It's not that EBITDA multiples have come down. They are still between 6x to 8x, 9x, some cases 10x. But now they're more consistent. They don't vary so much from brand to brand. It's not that an aggregator will buy some brand at 3x if they can negotiate hard, and then some brand at 20x if they really like the brand. Because founders have also wizened. They have realized like, hey, they can sell their brand, they can extract a good price. There's no desperation on the founder side because they have seen more and more aggregators entering the market. There's more capital coming in. So that's a big advantage. That's a sign of market is maturing. And it's a good thing for both founders as well as buyers and aggregators. Because now both know what to expect. Both are very open to negotiation. They can have better structures.
Awesome. Thank you very much, Pushkar, on that aspect of it. So there's a question initially with Anirban asked for startup, what is the ideal revenue figure post which it can look for initial funding, right? I guess that is addressed in this. Otherwise, from what I've been talking to Pushkar, it's just about a crore ARR or TTM. Is what ideally is a good figure to attract buyer interest. Not that it's lesser than that won't attract interest, but Pushkar's thought process is that if you're doing 50 lakhs a year and you can the time frame which you require to grow to 1 crore a year is very less comparatively, and the effort is also less comparatively, so and which commands better figures, better
Just to
sure.
just to interrupt the laws. So I think the number we discussed was 50 lakhs per month, not per year.
Sorry, my bad.
Six.
Yeah, 50 lakhs per
So
year, right?
just let's explain what TTM is. So TTM is trailing 12 months or your last 12 months revenue. So when you approach any buyer, they would like to see what have been your revenue and EBITDA numbers for the last 12 months. So say right now we are sitting in January 2022. So they would like to see what were your revenue and EBITDA from January 2021 to December 2021. You get a multiple of that. But had we been, say, 6 months down the line, we are in July 2022, then your TTM would be from July 2021 to June 2022. So last 12 months. Now, what we're observing 4 5 months ago was if you're selling less than $1 million a year or roughly 50, 60 lakhs every month, there was not enough interest because buyers were trying to acquire bigger brands to start with. But now again, market has matured. So we are doing a deal where the seller is only doing 3.5 crores every year last year. So 2021, his revenue would be 3.5 crores, 21% EBITDA. And he's getting a good price for it. So now buyers are also interested in acquiring smaller assets as long as they believe they can grow the category, they can grow the business.
Awesome. Okay,
So revenue threshold has come
piece,
down
right?
now.
Right. So I guess that also addressed a couple of questions which we got here, right? Jay has something on EBITDA over here. I think it's relevant, so I'm picking up Jay's question. Is the industry looking at EBITDA multiple for sale of Amazon Marketplace brands and revenue multiple of pure D2C brands that sell majorly through their website or on their data? Did I understand the question right? I guess you're
So it's
asking.
I'll answer this question.
Yeah, please.
So it's an interesting question, Jay. So it depends how much you're selling through your own website. Now I'll give you an example. Assuming there are two brands, both are doing 1 crore sale every month. Now one does 80-90% on marketplaces and maybe only 10% through their website. The other one does 80% on their website and only 20% through marketplaces. Now both will acquire different kinds of aggregators because every aggregator has a strength. There are some aggregators who specialize in Amazon and Flipkart. So for them, it's really easy to grow Amazon and Flipkart brand. So if you're doing 90% sale on your own website, they might not be interested in you, or you'll get a really low valuation. It doesn't make sense to sell to them. While the aggregators on the other side, so there's a new startup that has come up in Germany. We had a conversation with them. They just raised $5 million in the pre-series A round. They want to acquire smaller niche brands who only sell through Shopify. So say if you have a Shopify integration on your website, and if you're doing 20, 30, 40 lakhs of sale every month, I would say under half a million euros, they could be the right guys for you because their strength is not scaling up brands on marketplaces like Amazon, Myntra, or even Flipkart. They want Shopify brands. And on the valuation part, there is no hard set. So even if you say I want a revenue multiple, if I'm selling through my own website, eventually a buyer will always link that revenue to EBITDA. So they might give you a 1.5x revenue multiple, but eventually they will ask you EBITDA and they'll have an EBITDA multiple. They'll just give you revenue for you because for you it's easy to understand.
Okay, that's interesting. So Jay, I hope Pushkar addressed your query. And one more query which we had just about that, Amir, right? We don't want to, it's just otherwise we'll just skip it, right? We'll lose it because the comment is going on and on, right? So are aggregators only looking at acquiring brands selling across various marketplaces? Is this mandatory? What if brands are selling on their individual websites? I mean, that has also been addressed here. But I guess a healthy mix is always good, right? And I don't understand why brands wouldn't sell on marketplaces, and just on their websites alone. This is a good branding exercise to be present everywhere, right, where your customer goes. And probably the ultimate objective would be to, bring them all back to your website and make them buy. The repeat purchases should happen in your website. That should be the ultimate sales and marketing objective, in my opinion, right? Pushkar, we have a couple of more questions coming up, so I don't think I'm going to get. Um, much time for my questions because I had some questions for you, but it seems like you're running short of time and we have more questions from folks. So Deepak has a question for us, which is basically, uh, yeah, how difficult is it in the current scenario to raise seed funding for a startup working in healthcare D2C segment, Practo kind of business model? Practo is for a D2C business model. Am I right or am I wrong? I'm not sure. But healthcare segment, what do you think, Pushkar? Is there any traction for healthcare segment currently? What is your experience so far?
So when you say healthcare D2C segment, are we talking about your brand or are we talking about a platform like a platform? My sense is like there's still a massive demand for, there's still a massive appetite of venture capitalists in India, either if you're creating a good brand or a niche platform. So should not be very difficult assuming you have a good team and you're doing something quite different from what Practo has done. You just can't say like I'm replicating Practo's model and give me money. No one is going to
But
do that because
say
there's
that
no
we are
way you can.
replicating a international company's model, we do get money, right?
Yeah, as long as no one has replicated that in India. Yeah, but that's
All
correct.
right.
Some of the India's greatest successes were built on that, like be it
Sorry, I
Flipkart,
just couldn't
Ola.
stop myself from cracking the joke. Yeah. Anyways, yeah. So,
Yeah,
yeah, you're saying, did I stop? I'm sorry to sort of disrupt your thought process. But if it's a D2C business, sort of delivering medical or healthcare related stuff, that would be D2C business, right? Directly to consumer. I think we cannot directly send prescription medicines, but anything apart from that, of course, is a in the healthcare segment is a D2C business, right? So if that is the case, then
yeah, yeah. So I think outside medicine, let's say you want to sell some healthy food. So there's a massive appetite, there's a massive venture capital appetite for such niche brands because more and more Indians are getting richer. They don't want to buy generic food, especially the younger generation. But you should always remember the competition is intense. And I mean intense. It's crazy. We don't know how many new brands, how many new food brands are coming up every day. And I have seen good startups with good founding teams at 50, 60 lakhs monthly revenue, struggling to raise venture capital. So they raised the first round of, say, a million or something like 5, 6 crores. They reached a 5, 6 crore ARR, but they were not able to raise the next round because the VCs just couldn't see the brand scaling up or the team, good team, someone a team that can make this a $100 million brand. So the competition is intense. But if you have a good team, good product, if you can evidence good traction, VCs would be interested. It's all about checking these three boxes. But it's
Awesome.
very difficult to get money on an idea. If you want to
Right.
say, I want to launch healthy millets, give me money. If you know a VC personally, that's fine. And of
And
course,
how
you
about
can.
the aggregation part? I was more keen on, since I mean I'm sure this is not very related to the
Right,
question,
right.
but in healthcare segment, are you seeing any D2C healthcare segment? Are you seeing any brands coming up and for sale or aggregators showing interest in it? The ones you're talking to, the new ones, I know that's secret, right? You're talking to a lot of them, international ones coming and planning to enter into India, right? So any of them looking at healthcare segment?
Not exactly, because most aggregators are staying away from food
Okay, you broke
and
my heart.
fashion fashion. So only I think Mensa has a strong fashion focus, except that
Hmm.
it's slightly challenging to sell a fashion brand because again
Hmm.
it's a very thin margin business. It's difficult to scale. It's
Hmm.
difficult to develop a moat. Same with food. It's very difficult to change people's eating habits. That's the last thing that changes. Like for us, we are still eating the food we grew up eating as kids. We might occasionally go out and eat a pasta,
I
but
I
very
would
much
beg to
pasta.
disagree on that. I mean, not with the entire aggregators for that matter. That there is a lot of innovation happening on food. I have a food startup that's recently anyways, right? So
No, no, I'm
I
only telling
refuse
from
to
an
accept
aggregator
it.
point of view. Right now,
Yeah,
aggregators don't understand food well, so they're
but
staying
then
away from food.
but that said, I guess Pushkar, there's a lot of innovation happening. I've been practically following this industry for Western reasons, and a lot of innovation is happening, like ready to eat, RTC, and plant based, and a lot of stuff is happening
Right,
around. So
right.
I'm assuming that it's just a matter of time, and aggregators will realize their folly and come back after food startup guys like us, right? Anyways, so one more question from Jay. I have another question for you guys. Do aggregators prefer a large in-house team, are relatively lean in terms of team strength? Companies with outsourced functions also accepted?
Yes,
What's your
totally
opinion?
accepted. Not a challenge. Because most aggregators have created really large teams. So they have had a lot of people from Flipkart, Myntra, Amazon, also people
Right.
who understand supply chain logistics. So as long as you have a strong business, you have created a good brand, they're not acquiring you for your dream. It's not like what we call acqui-hire, where they acquire your business for your team. Here they are acquiring your business for the brand. If you have
And the
created a great
customers.
brand, and of course the customers, so revenue. So if you have a great brand, even if you have created by yourself, that's totally fine. They're not
Right.
really bothered about
Awesome.
that. They have great
Yeah.
talent at their disposal.
Yeah, adding just 2 cents onto that is that as a marketer or a salesperson or a strategist, right? I jump at a team which is lean. Actually, I mean, it makes perfect sense, right? Your EBITDA is also increasing, right, with lesser operational expenses, right? So it should always keep your team lean, but don't forget to hire the right talent. You cannot be penny wise and pound foolish, right? And so I guess especially you have time, right? You gave me time to 2:30. I mean, we had like 10 minutes
We
past
can do
that
maybe
almost.
if there are more questions, we can do one or two more questions. Or if you want to ask something, we can just wrap up in
Yeah,
next
yeah,
6 minutes.
yeah. There's definitely. I'm keeping 5 minutes for myself, man. Like I'm hosting this event and I'm not getting any time at all. Technical glitches apart, right? So yeah, there's one question from Kunal. So sorry, I'm not reading the questions. I'm just displaying it and then reading it directly, right? So maybe might have been addressed earlier as well. Sorry, Pushkar. Will these aggregators increase the cost of doing business on marketplaces? Okay, I'm not sure I understood the question. Um
No, interesting question, Kunal. So what I think what Kunal wants to know is, see, he is already selling on some marketplace, and he decide not to sell to an aggregator, continue selling his own business. Like, so will it become more difficult for him to sell on marketplaces? I don't think the cost of business doing business on marketplaces will increase for those brands who decide not to sell, but the competition will be intense because all these
Hmm.
aggregators are very well capitalized. So they can spend more on marketing, they can hire better team, they can offer a better customer service, much better logistics and supply chain, packaging. So if you're deciding like if you're a niche brand and if you decide like all right, I don't want to sell, which is also fine, you can grow it, but I foresee competition going stronger going forward.
Absolutely. Absolutely. And
That's my
plus,
guess.
the larger an aggregator would have a couple of brands, right? So I'm assuming that the way I've seen the negotiated marketplace is that when you have more brands and more buying capacity, and by purchasing capacity, right? Advertisements on marketplaces or logistical support and better deals, better commission rates. They tend to get better, everything better, right? As against a single brand owner. You take any platform and food platforms for sure. I'm experiencing it right now, and go to even e-commerce platforms as well, right? So that will be a disadvantage for an individual player or a small brand player, right? So yeah, that's another challenge, and of course the shared cost of marketing. You don't need to hire a content writer just for one brand. You have a content writer across multiple brands, right? So that definitely reduces the cost of doing business. Right. So, Pushkar, the most I don't have any more questions right now. I guess people are done with it. You have shared almost all the knowledge.
We
Right.
can just
So,
wrap up.
I have a question, man. I mean, I need to, please let me also
Yeah.
ask a question, right? And feel good about it. So, Pushkar, 2022. I am more interested in 2022, right? I read an article recently that the entire Thrasio model in India is getting the Thrasio from US, excited about it and planning to enter into India. So since you have been following this industry a lot, so I just thought I'll avoid reading about it and rather hear it from the horse mouth, right? What do you think? Is
Yeah.
Thrasio
So of
coming into
course,
India? How is it going to affect
Thrasio
us?
has already entered India. We know that it came
Is
in the
it?
news. So
Okay.
they have done a JV with Lifelong, which is one of the largest sellers, Amazon sellers in India. They're a really big company with dozens of brands under their portfolio. So there will be Thrasio's acquisition arm in India. So of course Thrasio is already here. And then the other companies like Razor Group, Bowling Brands, Perch, they all have plans of entering into India. It might happen right now or in 6 months or in 1 year. But India is a big e-commerce market. So no one can choose to ignore it. There's one insight I would like to share because I found that quite interesting. What aggregators are doing is they are changing the perception of founders. So right now, founders were creating building brands
Mm-hmm.
because either they wanted to raise venture capital, grow it really big, or they wanted a lifestyle business where instead of like having a job, they could have a business that would pay off their bills. Now, what we are increasingly seeing is founders are creating brands to sell it to aggregators. Now, this is a new option. This didn't exist 1 year ago. So, like we have heard the term like serial entrepreneurs, right? My sense is we'll see a lot of serial D2C founders in India, people who are good at creating and scaling a brand to a limit. So creating like quickly in 1.5 year, you create a 10 crore brand, sell it to an aggregator. There'll be aggregators who will be very keen on acquiring the brand on days. Like you won't have to hand over the brand to the company. And then they can continue and then they build another brand and sell it. So that is one trend I think will come to this country. Another very interesting trend I am seeing is we spoke to a couple of guys who are trying to raise small amounts of capital, who want to become aggregators, either growing their in-house brand or acquiring smaller brands. Now, their idea is to acquire really small brands that are doing 50 lakhs a year or 75 lakhs a year, grow them to a certain scale, and then sell the entire portfolio to an aggregator, to a big aggregator. So they are trying to create a portfolio of small brands, grow them to a level, and then make an exit, sell them to the aggregator. The advantage to an aggregator is like they don't have to go out after individual brands. They can just speak to one seller who has 10 brands and Zoom. All of a sudden, they have these 10 brands. So these are two trends I think will happen this year. Founders will start building brands, keeping aggregator in mind, New small aggregators will come up who will raise small amounts of capital, build a portfolio for bigger aggregators, grow them, grow that portfolio, and then sell them to the aggregator, like to Global Bees or Thrasio.
That's very interesting, actually. Yeah. Uh,
I
but
also think so.
one quick question though. Starting from where we started off, that the market is maturing, the pricing and everything is maturing, what you're getting is maturing, right? Wouldn't more aggregators coming from international market and the smaller aggregators you're saying, who are aiming at selling it to the larger fishes, right? So wouldn't it create more, I mean, wouldn't it destabilize this maturity which you're predicting?
So, if you're talking about valuations again creeping up high, I doubt it will happen. There'll be still some deals where people are getting 12x EBITDA multiple. That will happen. Should happen if there's a great brand. But as more and more big aggregators are coming into India, they would also have something to go by. They would also see, all right, the existing aggregators, they have acquired a lot of brands, what kind of valuations they have done. Founders would also have matured by then. So a new aggregator necessarily won't pay a 20x multiple or 10x multiple because by that time we'll have enough market data to know, all right, this is the multiple that's happening in this country. And say if Perch or Bowling Brands Razor Group decide to come to India, my sense is they would try to, instead of acquiring one individual brand at a time, they would try to acquire small aggregators. A small aggregator that already has 10 brands, 10 niche brands that have grown them to a certain level. Because for them, it saves a lot of time and they get 10 brands at one go. So that is one thing I foresee happening in this country.
Awesome. Awesome. Sorry about that. All right. So apart from the new entrance to the market, the new kind of aggregator business model happening, and the market maturity or instability, debates about that. Anything else that is going to happen in 22, making it more exciting? I mean, I took off my dadi and all the sage look of thinking that 2022 will be very exciting, man. So give me some more hot news.
So I think one way that what I see is the founder mindset, like for a lot of founders, how mindset is changing is not everyone wants to raise venture capital because
Mm-hmm.
raising venture capital is running on a treadmill. You can't stop. You raise some money, grow the brand, again raise money, grow the brand, keep raising at a higher valuation. And maybe you get an exit in 10 years, 8, 9
Mm-hmm.
years. Either you sell your
Mm-hmm.
brand to a bigger company or someone acquires you. Or you become really big like boat where it's fine. You don't need to do either, like you're good.
Mm-hmm.
But most founders don't want to run, not most, but a lot of founders don't want to run this rat race. They think, all right, I sell to an aggregator, and then
Mm-hmm.
my money problems will be solved. I won't have to raise new capital every time I want to grow the brand. Every 18 months, I don't have to go on a fundraising spree. Because once I have sold to an aggregator, they'll have enough capital to grow the brand. I won't be lacking money for digital marketing or
Mm-hmm.
logistics or anything. So this is I was talking to a founder and this is what I realized. He said, I don't want to run this venture capital rat race where I'm raising capital every 18 months. I want to quickly sell to an aggregator, stay with them for 4 or 5 years, grow the brand, and then build something around the brand. So maybe build a community around my brand, build an
Mm-hmm.
online marketplace, something like that, which an aggregator will be very happy to assist them because then they can sell the brand, and of course through that community they can sell their products more, and it can also help the other products. So see, the industry is in a flux. The only thing that has stabilized is the valuation. Now we are not seeing a lot of obnoxious valuations, but except that, there's so much happening. We still don't know how this will pan out. The kind of ideas these smart founders have, aggregators are
Right.
also learning. So yeah, it's crazy and it's unbelievably exciting because the
Right.
innovation we are seeing right now, 23, could be totally different. We might see a
Yeah,
totally different thing.
and I mean, I can also say this just from a different perspective is that this entire aggregation model and this D2C business getting like such a boost, right? It's also creating different kind of economy, like the creator economy, right? Where in social selling, people are selling through TikTok videos and years and all. I mean, it's a big thing already. The influencers selling and all the stuff, right? So these things are also going to give a lot of jobs and create a lot of independent business models and structures as well. In the way I see it, I might be a little optimistic, but I guess it'll get a boost. That's another ripple effect of this D2C business getting this thing. Getting this so much of backing and so much of interest, right? One last question, Pushkar. Have you have a question, and we can just close it after that. What do you think?
Okay, one final question. I'm exhausted.
Yeah, one final question. Sorry, I can imagine, man. But yeah. Anyways, given the spur in the growth of gaming sector over the last 2 years, maybe, how willing or keen are VCs or investors on gaming D2C brands, which focus on a hybrid model of physical stores as well as online presence? Also, how do such brands get benchmarked if? Yeah, I don't think the rest of the question is there. Pushkar, so I just three things which stands out of it is basically one, gaming sector, any interest in D2C business in gaming sector. One, it could be the educational games as well, right? I've seen a couple of brands out of Gurgaon working on that. Second is, he's also talking about VC model, right? So, uh, VC investor versus D2C is a big thing. Which one to, uh, are they, rivals to each other, sort of thing? That's a common question I've heard, right? And hybrid model, physical stores versus online presence. So we'll start with the physical store and online presence. I guess physical stores are no for this kind of aggregators, right?
Yeah, especially for an aggregator, right now the model is online because it's difficult to scale up physical stores. But eventually, people realize like you can't just keep growing online. You will have to be like what the word we use omni-channel. So you would have
Right.
to have an online and offline mix.
Hmm.
Smaller brands, if you're selling to an aggregator, they would prefer you to have like an online, like at least 80-90% of business through online channels. But
All right.
once you grow up, once you become a 100 crore brand, you would have to get into offline
Right. Right.
vertical.
And
Otherwise,
plus,
it's
of
very
course, the cost
difficult
of
to scale.
right, but the cost of offline is also too much, right? I guess for an early stage D2C startup to
Right,
burn
right,
money onto that, right? I mean, you're selling your EBITDA is it's all the multiples of EBITDA, right? So I guess
right.
EBITDA will really go down if you have an offline store. So yeah, that's something which has to be considered. And investors or VCs versus D2C, I guess we should do a separate segment on
Okay.
that. Right? But yeah, anyways, for now, yeah. What do you think? Are they rivals, V2C, VCs and investors versus aggregators?
Not exactly, because I think both are targeting different brands. Eventually, I think they will become rivals. Right now, the pie is really big. So there are
Mm-hmm.
more brands than what an investor can fund or aggregator can buy. There are like thousands of brands sitting there. VCs usually invest in brands that are early stage, that have grown rapidly in most cases.
Mm-hmm.
Aggregators buy brands that are profitable. Profitability is not a criterion for VC, at least current
Mm-hmm.
profitability. A company like India's biggest D2C success story, Licious, is nowhere being profitable, and its valuation
All
is
right.
almost $1.5 billion.
Right.
But they're not, they're also a platform, so they are slightly special.
Mm-hmm.
They will eventually, I'm sure, become profitable. So I
Right.
don't think they are rivals. Coming on the gaming side, there's a lot of VC interest on gaming. Like India
Mm-hmm.
has seen some massive gaming companies, gaming startups who have raised capital. Nazara is our greatest success story. They came up with an IPO
Right.
last.
Right.
On the aggregator side, people still don't understand gaming so well.
Mm-hmm.
Most of the gaming in India is free. People don't really buy games online, or most of the games they buy are made by Sony or Microsoft, like big gaming, big
Right.
gaming companies. It's very difficult to create a world-class PC game through a startup. At least not now. It will take time. So if you want to do a gaming startup, I think venture capital is the way to go.
Right.
Aggregator is maybe not the right target, at least now.
One quick follow up on the rivalry between VCs and aggregators. I mean, non-existent rivalry between VCs and aggregators, right? I guess it doesn't. It's in the best interest of VCs to actually have invest in aggregators like Thrasio over individual brands. Like they get more portfolio and more stability. The risk factor is minimalized, right? Even if one brand fails, there are like 10 other brands. So, in a way, to look at it, I mean, if I had money and I would have been investing, probably I would have invested in aggregators. Don't you think?
So all aggregators have raised money from VCs.
Yeah.
The capital is eventually comes from the VC. Say, for example, Global Bees, Chirata is an investor in Global Bees, one of the India's best VC. Fireside is
Right.
invested in 10 Club, I think.
Hmm.
So
Okay.
the capital that these VCs are raising, these aggregators are raising, are from VCs, very large VCs. SoftBank is a VC. They are
So
the
it's a
biggest
symbiotic
investor in
relationship.
this. Right. So if I'm a VC and I don't want to directly take a call on individual D2C brand, but I'm
Hmm.
bullish on the sector, I'll invest in aggregator. I'll go the aggregator way and trust the aggregator to build a team and acquire brands, grow them.
Right, right, right. So, anyways, I guess that's the questions. You're tired. You're extremely tired. I can see that, right? But
Not
thank you very much for the
exactly.
time, and
You're
I hope
welcome.
Sorry. Yeah. So
I
I
said
guess
you're
LinkedIn
welcome.
Live was not that bad either. I think it's a network which is playing games with us. Ever since the last few years, and we have transitioned to 4G. I mean, the internet has been pathetic, right? So, so I guess we should give it more try. But I hope everyone, it went seamlessly after the initial glitch, and you guys can hear us and could hear it, and we were able to give some useful um thoughts for you to consider, right? And address your queries. Keep it coming. We're thinking of doing a couple of more. We are looking for great ideas actually. So if you have any ideas or any topics which you want us to talk about or figure it out, Pushkar being the pearls of wisdom man, he will figure out the bit, and analytics bit, and I'll find out the
You
technical
have
bit.
to you have to stop pulling my leg, Dolores. Otherwise, I won't
Yeah,
talk.
yeah, yeah.
You
Yeah, I
just
guess it's getting a little old now. We need to get a new host, man. I'm really, I'm looking forward
you
to
you just
more
can't pull
legs to
my
pull.
leg every time.
Yeah, I mean
All
that's
right.
fun, right? That's how you keep it, right? So let us know if you have any thought process, right? Or thoughts or any topics which you have. And sorry for the glitches. We're still learning how this LinkedIn Live works. Hopefully
Yeah,
next time we'll do better.
it's crazy. Dolores
Yeah.
will also put the video on our YouTube channel, right?
Yeah, yeah. So yeah, YouTube is a great platform for us to, for you to check out the old videos as well, right? So a lot of people have been asking questions, which we have covered, and we are trying to cover it again and again, but time is a concern, right? So you can always go to the Tremors Capital. You can search for Tremors Capital on YouTube, and you can find, and or you can go to the, we tend to post the LinkedIn, post the links on LinkedIn, right? So you can actually go and click onto that and see the ones which we are doing right now, or the ones earlier as well, right? Anything else, just drop us a message. We're more than happy to help. This is the fun time, right? Thank you very much for participating, Pushkar, and thank you very much for your time.